One catastrophic lawsuit or a single kitchen fire could vaporize your entire rental portfolio tonight if your insurance policy has one fatal loophole. Most new landlords mistakenly assume their standard homeowner coverage protects them, but that assumption is leaving them completely exposed. I have personally watched investors lose everything they built simply because their policy contained a technicality that rendered their coverage void the moment a tenant signed the lease. Major loss. But there is a specific way to structure your coverage that actually adds to your monthly cash flow rather than just draining it. And the final method I am going to share, it is something most veteran landlords keep under wraps, but it effectively shifts the entire risk profile of your business. So grab a notebook, settle in, and let us break this down. When you buy a house to live in, your insurer calculates risk based on your lifestyle, your credit, and your personal possessions. Once you add a tenant, that risk model explodes. An insurance company looks at a rental property and sees a high chance of property damage caused by people who have no skin in the game. That is why you need a specialized landlord policy, often called a dwelling fire policy or landlord insurance policy. Unlike a standard policy, a landlord policy typically covers three main pillars. First, there is the physical structure. This covers the home, the roof, the walls, and any permanent fixtures. Second, you have liability protection. This is arguably more important than the property coverage itself. If a tenant slips on an icy driveway or a guest gets injured due to an improperly maintained railing, you are looking at a potential lawsuit that could run into the six figures. Third, you have loss of rental income coverage. If a kitchen fire makes the unit uninhabitable, the insurance company will pay you the rent you would have collected while the unit is being repaired. Think about that. You are still getting paid even while your investment is sitting idle. The first win for you today is understanding how to negotiate your deductibles to lower your premiums immediately. Most landlords stick with a standard $1,000 deductible. That is a mistake. A study by the National Association of Insurance Commissioners found that increasing your deductible from $500 to $2,500 can reduce your annual premiums by as much as 25%. Imagine you own 4 properties. That is thousands of dollars in savings every year just by setting aside your own emergency fund and taking on the minor risks yourself. You are essentially acting as your own insurance company for those small claims. If a tenant breaks a window or a pipe leaks, you pay for it out of the savings you built up from lower premiums. This turns insurance into what it was always meant to be, a protection against catastrophic loss rather than a maintenance fund. Start doing this today. Check your policies, bump up those deductibles, and watch your monthly cash flow improve. It is the easiest way to optimize your property performance without doing any extra work. Now, here is where things get interesting. You have your basic structure covered, but are you protected against the human factor? This is the level up you need to consider. Most standard policies have massive exclusions for damage caused by tenants. If a tenant goes on a destructive rampage or simply refuses to pay rent for 6 months during an eviction, a basic policy will laugh in your face. You need to look into an add-on called rent loss and malicious damage coverage. I remember a client, let us call him Marcus, who bought his first triplex back in '05. He thought he was fully covered. When a tenant decided to renovate the kitchen without permission and gutted the electrical wiring, his insurer denied the claim because it was deemed intentional damage by a resident. He ended up paying $20,000 out of pocket to rewire the entire unit. Don't be like Marcus. You should specifically ask your agent if your policy covers malicious mischief. Many policies include this as a standard clause, but you have to verify it. Additionally, if you are in a state that is slow with the eviction process, you might need a policy that extends rental income coverage for up to 12 months. In some jurisdictions, an eviction can take nearly a year from start to finish. If your policy stops paying after 3 months, you are the one holding the bag for those remaining 9 months of lost revenue. Verify your coverage limits on loss of rent specifically. It is a nuanced detail that separates the hobbyists from the professional investors. If you are finding this breakdown helpful, hit subscribe. I drop deep dives like this every single week to help you scale your real estate business with confidence. If this is clicking for you, a quick subscribe helps me keep making these videos. And honestly, stick around because the best part is coming up next. Okay, so that covers the basics and the middle ground protection. But what if I told you there is an even more powerful, less talked about way to protect your assets? All right, remember how I said I had a trick for you that most people don't talk about? Here it is. It is the umbrella policy. Most landlords operate with $1 million in liability coverage on each individual property. It sounds like a lot, but in a litigious environment, one serious accident can easily exceed that limit. An umbrella policy sits on top of your primary policies. For a relatively low annual cost, usually between $200 and $500 per $1 million of coverage, you can add an extra layer of protection that covers all your properties. Let us look at the math. If you own three properties, each with a $1 million liability limit, and you get hit with a $3 million lawsuit, your individual policies might fall short. The umbrella policy kicks in to cover the gap. But here is the secret most people miss. The umbrella policy often covers incidents that your standard landlord policy specifically excludes. Things like libel, slander, or even certain types of property management errors can be bundled into umbrella coverage. A friend of mine who owns a portfolio of 20 units in the Midwest saved his business when he faced a massive lawsuit from a slip and fall accident. His primary insurer tried to fight the claim, but because he had an umbrella policy, he had access to higher tier legal counsel that his primary insurer didn't provide. It is not just about the money, it is about the legal muscle you get. When you have an umbrella policy, the insurance company has a vested interest in fighting your case effectively because their money is on the line too. This one shift alone could protect more wealth than the first two methods combined. Once you see the umbrella as a necessary expense rather than an optional add on, you realize it is the cheapest insurance against losing your entire net worth. Let that sink in for a moment. Think about how much peace of mind that buys you. You have now learned how to optimize your deductibles for immediate cash flow, how to scrutinize your coverage for tenant related gaps, and how to use an umbrella policy to secure your entire financial future. These are not just insurance tips, they are the fundamental pillars of asset protection. Most people never look past the price tag on the premium. You now know that the price tag is the least important part of the policy. The definitions of coverage, the exclusions, and the stacking power of your limits are what actually keep you in business. So take this knowledge, review your current paperwork with a fine-tooth comb, and make sure your portfolio is truly bulletproof. If you got value from this, share it with someone who is currently looking at their first rental property. They are going to thank you later. Subscribe so you do not miss my next video where we are going to dive into how to legally structure your property ownership to minimize your taxes. That is the other half of the puzzle for every successful investor. Stay smart out there, and I will see you in the next one.